Ladies and gentlemen, what you are about to hear is not just another headline. This is a warning signal coming from the very core of the global financial system. Just moments ago, COMEX, the world's most important commodities exchange, halted silver selling entirely. Not because the market had stabilized, but because 45 million ounces were claimed within minutes. When markets behave like this, it is not noise. It is a siren. We often hear that markets discover prices. What we are witnessing right now is not price discovery. It is stress response. This is not volatility. This is the system reacting to an unsustainable gap between paper claims and physical reality. This is not a technical glitch. It is not a coincidence. It is unprecedented market pressure unfolding in real time. When an exchange of COMEX's scale effectively freezes silver trading after tens of millions of ounces are suddenly demanded, that is not a sign of strength. It is a sign of strain. A system carrying more weight than it was ever designed to hold. For years, the silver market has been dominated by paper promises, not physical metal. Contracts have been traded in volumes that far exceed the amount of silver actually available for delivery. And under normal conditions, this illusion works. Most participants settle in cash. They roll contracts forward. They speculate. But the moment confidence shifts, when too many players demand real silver instead of paper exposure, the structure is tested. And right now, it is cracking. 45 million ounces claimed in minutes is not retail hype. It is institutional scale demand entering a market that is already tight. When supply is abundant, markets adjust. Prices rise. Sellers step in. Equilibrium returns. A freeze happens when sellers disappear, or when they refuse to sell at prices that preserve the system's appearance of stability. This is not about protecting investors. It is about protecting the system itself. Silver inventories have been declining for years. Industrial demand continues to grow. Investment demand resurfaces during monetary uncertainty. Mining supply struggles to keep up. Yet prices remain suppressed by leveraged paper trading. This imbalance survives only as long as trust holds. Once trust erodes, the reaction is sudden and violent, and the broader economic backdrop makes this even more significant. We live in an era of excessive debt, chronic deficits, constant monetary intervention. Confidence in currencies is supported more by narratives than by fundamentals. In that environment, real assets like silver become barometers of trust. When physical demand surges, it often reflects deeper concerns about the value of money itself. Crises like this do not appear overnight. They build quietly, while official voices insist everything is under control. But markets have a way of revealing what institutions prefer to hide. A trading freeze is a flashing warning light. It tells us liquidity is thinner than advertised, availability is more limited than assumed, and the system's margin for error is shrinking. Some will argue this is temporary, that normal trading will resume. But the underlying issues remain. Paper claims still outweigh physical supply. Inventories are still tight. Confidence has already been shaken, and confidence is not restored with a press release. The real danger is not a single freeze. It is what the freeze represents. Stress rarely stays isolated. It spreads. Silver may be a relatively small market, but it is deeply connected to monetary systems, industrial supply chains, and financial confidence. If this market struggles under pressure, what happens when larger markets face similar strain? Financial systems do not rest on formulas. They rest on belief. And when belief wavers, consequences follow. This is not just a story about silver. It is a story about the limits of paper markets, the cost of long-term distortion, and the moment when reality reasserts itself. Cracks always form quietly. Then suddenly, they appear everywhere. Ignoring them does not make them disappear. It only ensures the next shock will be harder to absorb.